Before a bank releases money for a home, before a cargo ship leaves port, before a hospital installs a new machine, and before a company signs a major contract, someone asks a quiet question. If this goes wrong, who pays? For decades, the answer was easy to overlook: insurance. But that answer is becoming harder to take for granted. Climate losses are rising. Cyber risk can cross borders in seconds. Artificial intelligence is entering underwriting and claims. And in some places, cover is becoming more expensive, narrower, or unavailable. The global property and casualty market, covering homes, cars, factories, ships, liability, and much of business risk, recently reached about $2.4 trillion in annual premiums. That is roughly $6.6 billion every day, double the market size 20 years ago, before life and health insurance are counted. And that $2.4 trillion is not profit. It is the price of risk passing through the system. Insurance looks like paperwork. Underneath modern life, it behaves like infrastructure. And today, that infrastructure is being reshaped by three questions: who reaches the customer, who controls the data, and who has the capital to keep the promise. Think about a mortgage. The bank does not only ask whether you can repay. It wants to know what happens if the building burns, floods, or becomes uninhabitable. A business lender asks what happens if a factory stops, a machine fails, or a customer is injured. A shipping company needs protection for the vessel, cargo, crew, and sometimes the political risk surrounding the route. A hospital, airline, data center, or construction project can each carry losses larger than the organization operating it. Insurance does not remove those risks, and it does not provide legal permission for every activity. It provides something just as important: economic permission. It converts a potentially ruinous loss into a price shared across many policyholders, investors, reinsurers, and years. That changes decisions before anything has gone wrong. A lender can lend. A company can invest. A ship can sail. A family can rebuild. Insurance is not only the system that pays after an event. It helps decide what can proceed before the event. That role grew out of trade, information, and repeated disaster. After the Great Fire of London in 1666, the financial cost of urban catastrophe was impossible to ignore. By 1688, Edward Lloyd's coffee house had become a meeting place for merchants and shipowners exchanging news about vessels, routes, cargo, weather, and captains. Risk could not be priced without information. Those willing to accept part of a voyage's risk wrote their names beneath the terms. One origin of the word: underwriter. Insurance was a data business long before anyone used that phrase. Each new technology then forced the industry to learn a new language. In 1904, an early Lloyd's motor policy described the car as a ship navigating on land. 2 years later, the San Francisco earthquake tested capital and trust when a leading Lloyd's underwriter instructed his agent to pay policyholders in full. The pattern continues. Cars, aircraft, electricity networks, modern medicine, satellites, cyber systems, and artificial intelligence create progress and new forms of loss at the same time. Innovation scales when society learns how to finance the upside and carry the downside. At its simplest, the machine begins with a premium. But your premium is not placed in a personal box waiting for your claim. It enters a pool. Insurers use data and judgment to estimate how often losses may occur, how severe they could be, and how much must be charged today for promises that may be tested years from now. Some premium pays current claims. Some covers operating costs. Some supports reserves for claims that have happened but are not yet fully known. Insurers also hold capital for outcomes worse than expected and invest assets so future obligations can be met. When one storm, fire, or liability event could overwhelm a single balance sheet, insurers buy insurance for themselves. That is reinsurance, the hidden shock absorber behind the shock absorber. A factory fire can test the whole chain at once. policy wording, risk data, claims handling, reserves, reinsurance, and capital. The machine is not magic. It is uncertainty redistributed across people, places, time, and capital. The first modern control point is distribution. Who reaches the customer? Most people do not compare insurance balance sheets. They begin where insurance appears, through an agent, broker, employer, bank, comparison site, car dealer, travel screen, or digital platform. That moment influences which products are shown, how they are explained, what data is collected, and who owns the ongoing relationship. And the company the customer sees is not always the company carrying all the risk. A broker may advise the client. A specialist underwriting agency may design the product. A licensed insurer may issue the policy. A reinsurer may absorb part of the loss. A platform may control the screen and the data. Digital and embedded insurance can make protection faster and easier. But speed can create the illusion that a complex promise is simple. A policy can be purchased in seconds, while a flood exclusion, cyber condition, business interruption limit, or medical definition may not become clear until months later. Distribution is not a minor front-end activity. Whoever controls access to the customer can influence the premium flow, the data, and the next decision. The second control point is data. Who can see and interpret the risk? Insurance has always depended on records. Maps, mortality tables, repair bills, medical evidence, weather history, and claims files. Now the inputs can include satellite images, connected car data, building sensors, smartphone photographs, and live cyber signals. Artificial intelligence can read documents, estimate damage, detect unusual claims, support underwriters, and answer customers faster. Allianz says it has more than 900 registered AI use cases across its global operations, while a 2026 industry benchmark shows AI moving deeper into underwriting, pricing, distribution, and claims. That is a sign of scale. It is not proof that every use case creates value, removes bias, or improves the customer outcome. In insurance, an algorithm may influence the price of cover, whether a claim is flagged for fraud, how damage is assessed, or how quickly money reaches a family or business. The key question is not only whether the insurer has more data. It is whether the data is accurate, the model can be challenged, exceptions reach a human, and someone remains accountable. Technology can accelerate the promise. Trust determines whether the promise survives. The third control point is capital. Who can still pay when the model is wrong? An insurance policy is a promise made today about an uncertain payment tomorrow. Reserves estimate expected claims. Capital protects the company when experience is worse than expected. Reinsurance spreads extreme losses across a wider global market. Some catastrophe risk is even transferred to investors through bonds that release funds when a defined disaster occurs. Between premium and claim, insurers also invest. That places them at the intersection of households, businesses, and capital markets. Global supervisors reported stable aggregate solvency, liquidity, and profitability at the end of 2025. But they also highlighted pressure from illiquid assets, market volatility, debt repayments, dividends, and share buybacks. That distinction matters. A company can be profitable and solvent, yet still need to control when cash arrives, when claims must be paid, and how quickly investments can be sold. Capital's not simply a large number in an annual report. It is the ability to keep the promise when a storm hits thousands of homes, markets fall while claims rise, or a long-term obligation finally comes due. Claims are where distribution, data, and capital meet the real world. This is when a policy stops being a document and becomes a repair, medical assistance, replacement income, or the money that keeps a business alive. It is also where the limits of the machine become visible. In 2025, natural catastrophes caused about $220 billion of economic losses worldwide. insurance covered about $107 billion, the sixth consecutive year in which insured catastrophe losses exceeded $100 billion. The Los Angeles wildfires alone accounted for roughly $40 billion of insured loss. But around $113 billion of measured catastrophe loss still remained elsewhere. Those losses did not disappear. They moved onto households, businesses, banks, governments, and communities. Across Europe, only about 1/4 of extreme weather losses were insured between 1980 and 2024. In high-risk areas, rising prices, exclusions, or withdrawal of cover can affect property values and even mortgage availability. Sometimes the gap is hidden inside the policy. A customer pays a premium but misunderstands the limit, exclusion, or condition, what European regulators have called the illusion of being insured. The protection gap is not empty space. It is a transfer of loss to someone who may be less prepared to carry it. For individuals, the lesson is not simply to buy more insurance. It is to understand the promise. What is covered? What is excluded? How is a loss valued? Is the sum insured still enough for today's repair or replacement cost? And how does the insurer handle a claim when the answer is not obvious? For businesses, insurance should not be treated only as an annual purchasing exercise. Claims data, safety engineering, cyber controls, supplier resilience, business continuity planning, and clear policy wording can reduce both the probability of loss and dependence on a payout after damage is done. For insurers, transformation is not a new app or a large AI use case count. Distribution determines who reaches the customer. Data determines who understands the risk. Capital determines who can keep the promise. Claims determine whether the promise is believed. For governments, protection gaps mean private insurance cannot work alone. Building standards, climate adaptation, public backstops, risk information, and public-private pools may all be needed to keep essential risks financeable. The strongest insurance system is not the one that merely pays the most claims. It is the one that prevents avoidable losses, explains the remaining risk clearly, and still responds when prevention is not enough. Insurance is easiest to ignore when it works. The mortgage is approved. The aircraft takes off. The hospital opens. The factory hires. The ship reaches the next port. Behind each visible activity is an invisible agreement about risk, information, responsibility, and money. Insurance does more than repair the world after a loss. It helps decide which parts of the future can be attempted before the loss occurs. And as climate, cyber risk, artificial intelligence, geopolitics, and capital markets change the threats around us, the most important question will not only be what insurance costs. It will be what remains insurable, who controls the machine, and who carries the loss when the machine cannot reach it. This is Lessons Untold. Understanding the forces that shape our world.